Hey everybody, hey traders, happy Monday. Markets closed today. Oh, give me 1 second here, 1 second. There we go. Markets closed today. Currencies were open. Crypto was open. Futures went a little bit into the morning session, but they stopped trading around 12:45 p.m. today. So a little bit of movement right around the open, not much. Wasn't really expecting much out of the futures market today. We had a big pop here at 8:30 in the morning. Up around, I guess, about 50 points. Let me see what that pop was in the NQ feed. So from 539, so let's say 540 to 780, we got about 240 in NQ. So a little pop and then not much. Here's where we're at for the last couple of weeks of trading. I think this is bull trap territory. We'll talk about it more this week. We have some gaps that could be getting filled. You know, it was inauguration for Trump today. Let's see if we can look at some highlights. Let's take a look at some highlights. Trump. Clinton's booed. Lone Obama and other key moments. Oh, gosh. Yikes. Just drama, you know? Good Lord. What do we have here? Pence and the Clintons get booed in the arena. Jeez. This dude brings the ruckus, man. Crowd in the arena. Let's see. Anything from holding a man holding a Joe Biden you're fired sign to a shot of Rudy Giuliani has inspired enthusiastic applause, but a rare boo erupted in the crowd at the sight of Mike Pence walking into the rotunda. Okay. Barack Obama alone, CEOs of better seats than Trump cabinet members. We've got CEOs of Meta, X, and Amazon. Nod to the importance Trump has given the heads of some of those powerful companies, social media platforms, or the agency. No gift for Joe Biden. Okay. Awkward moment when he leaned in to kiss Melania, but appeared to be blocked by the brim of her hat. Right there. Mike Pence's wife also did not attend. It was a very short speech from Trump standards. Takes oath not atop the Bible. All right. Biden and Trump share limo. Interesting. As with traditions. There you go. All right. I would say this. It's going to be an interesting 2025 to 2028. Whatever it means, good or bad, we're going to deal with it. I like the strategy that I'm deploying this year. I did a couple of classes this morning on my daily profit play. We talked through a lot of the strategy. I have some good notes to share. If you're in my daily profit play service, if you're in my Waterfall income service, I would recommend you take a look at today's classes. You know, there was no market open, so we just got to talk shop, talk strategy. Had some, little tweaks and little updates to daily profit play, and pretty big modification on waterfall income, at least for this week's trading in particular, with some ways to add some income to it with some probabilities and some profit traps. So happy Monday, everybody. I'll type this in the chat right here. And if you're in the chat or watching this session, welcome. If you're watching it recorded, watching it live, if you're watching it live, obviously let me know. Pop in, say hi. If you're watching it after the fact, you can leave a comment, but that's cool too. We'll be back all this week. But we've had a nice little rip to the upside since we had a fresh low. I was curious how cooperative the markets were going to be on Friday. I was out of the office on Friday and traveling, and the market proceeded to gap higher. We had a nice little futures pop overnight Thursday to Friday, another pre-market move. We are right back to essentially the holiday levels with the gaps to the downside. I do wonder if this is a potential bear bull trap scenario where the market's not really able to go up too much higher without running some pretty heavy resistance at the upside. If we come back and fill some gaps in here, then price obviously can fall a decent amount. So that would put us into this area here. We could gap fill there, and we could gap fill there. All right. It wouldn't surprise me to see gaps get filled sooner than later. It could happen as early as tomorrow with at least the first gap filled. By the end of the week, we could be back down to fresh lows. I don't know. So I'm taking the open tomorrow. Hopefully, we stay right around this current level. Maybe the market gets a little excited to open up near Friday's high from last week. And if that's the case, that's good because I will be doing some work on my waterfall income trades. We have 7 open positions I'm looking to manage. 2 are like pretty guaranteed profits for tomorrow, and 5 are going to be open. They should be looking good for a decent chunk of profit. If they don't hit the profit target in full, at least a nice little partial. So I'll assess the total winnings on those tomorrow morning, and then daily profit play we will assess based on what we see in the VIX. It's Tuesday, and whether or not we want to go out a little bit further and see how those trades are looking. Where we have like another, I think 6 or 7 positions open there as well. Double up alerts was a good week last week. My Amazon trade actually did end up getting all the way above. So we closed on Amazon 225.94. I had a 225 by 222.50 by 225 bull call spread. I did not take full profit on that. I ended up taking a small loss at 20 cents because one, I wasn't trading on Friday, and two, the market was already down to 216, but I had a 225 liquidity level that I was eyeing last week, and the market did, in fact, rip right towards it. So directionally, it was a nice little run. And, I'm as curious as everyone else, like, what are these Mag 7 stocks going to do? Is Amazon going to revisit highs? Are we going to have like a big range on Amazon? Are we going to stay in some type of channel this way where it goes back down to hit lows? We come back and find some, deeper pullback zones. Or is it just lots of chop, lots of volatility, make some income, and that's about as good as it's going to get for right now. Until I'm a little bit more clear on direction or a little bit more confident that we have some higher highs to come or some all-time highs to be revisited. The only all-time high that we saw over the weekend and this week was Bitcoin. Bitcoin did make a nice little run. We had some stocks also like American Express I was looking at this morning that made an all-time high. We can actually take a look and see how many new 52-week highs do we have. So let's go to Scanner and go to all. Let's check 52-week highs, lows, new highs. So I've got 344 stocks in here, but let's see how many are actually tradable. So average volume, let's look at average volume over 1 million, down to 76. And how many are optionable and shortable? 72. So out of 7,000 stocks, we have 72 that are making some fresh 52-week highs. So top little list here, American Airlines. Let's see here. I'm just looking at some household names here. American Airlines, which I think might have some earnings this week. This week's earnings, the one that I'm going to look at, I'll price this out actually a little bit today. I did it in my session around 10:15 this morning. Netflix, I want to price out for some earnings. I'm looking at about an $85 move, an $85 to $86 move on Netflix. The weekly ATR is around $43. The last 10 earnings has averaged about a 10.21% move. So $85 gets us back up towards all-time highs, or it pushes us back down to some correction levels. And that's if we get a big move and leave some gaps. I think the market's going to be a little bit more excited about some of these earnings plays. We've got a little mix here, like 3M, consumer staples, and big company. That's a massive conglomerate there. Charles Schwab for the health of the investor. Same thing with Interactive Brokers, health of the investor. DR Horton for home builders, which would be similar to like a Toll Brothers, Lennar, Pulte. Fifth Third Bank, a lot of financials still getting sprinkled in this week. But I would say Netflix is one that I want to pay attention to. And, the other one, like energy stocks like Halliburton, might be interesting to watch. I don't know if I'm going to trade it necessarily. Johnson & Johnson in the healthcare space, also consumer defensive. More financials, Discover, health of the consumer, American Express. There's a decent move on American Express and MasterCard and Visa last week. Alcoa is always an interesting one with Alcoa makes aluminum. And I've played aluminum for the last handful of years. I've played steel like CLF and X. American Airlines, they do have earnings this week on Thursday before the market. We have GE Aerospace. There's a copper trade, copper and gold for Freeport-McMoRan. That's a nice one on Thursday. Let me use my little highlighter tool here. So let's go. Netflix will be something to watch. United Airlines. Maybe some Johnson & Johnson volatility. I'll highlight that one there. Abbott Labs. I think I have some exposure in Abbott Labs. I'll double check that. ABT. Kinder Morgan. That's energy. American Airlines. Freeport McMoran. Alaska Airlines. We have Union Pacific Railway. That's always a Buffett play. Just curious on that one. More banks and financials. Texas Instruments, Verizon on Friday, telecommunication, Amex on Friday. Again, kind of state of the consumer. Amex would be like the higher demographic, the higher spending consumer, maybe the wealthier, more higher asset consumer, and then more banks. South Plains Financial, Northwest, Next Air Energy. I want to look at that one too. All right, so we could have some earnings plays this week that I'll take a look at, maybe some surprises. Do you see Bitcoin with a pullback, buy the rumor, sell the fact, or full steam ahead? I'm not full steam ahead on anything, man. I think this market is going to be lots of pumps, lots of dumps, lots of rips, lots of rallies, lots of fallbacks, lots of volatility, lots of chop. I mean, if this is any indication of what we're about to see for the last basically month, right? If this is the last month, I mean, are we going to turn the corner and go like aggressively higher? I don't know. It seems like right now there's a bit of a reality in the market. I would say this though, the market. So how can we establish a strong bull market? Okay. So I think a strong bull market is going to have to come with a rotation and broadening. It's pretty simple. We can see that a little bit with what's happening right now. I'll get to some other thing here. So it's a rotation and broadening where we get out of Mag 7 with that 33 to 35% concentrated. Everyone's in Mag 7. The market cap in Mag 7 is ridiculous. It's bigger than like most countries in the entire world. It's insane. And the top 10 stocks were carrying pretty much 40 to 50% of the entire S&P gains last year and NASDAQ exposure. A lot of the gains were built around Mag 7. So if we don't rotate out of them, or we don't take those gains and reallocate, it's this simple. I mean, if people are in Mag 7 and they've made a bunch of money on it, if you're just doing the most basic rebalancing of your portfolio, so let's say that you like Mag 7 and 10% of your portfolio is Mag 7, and you can splice it up and say, I don't know, you can literally buy like mags and you can have exposure to each one equal weighted, or same price. You can dollar cost average in where it's like, okay, I put $10,000, which means I've got 10 stocks. So I got $1,000 in each one. And with that $10,000 invested into 2024, it's probably showing now your 10% allocation is worth, maybe $15,000, $20,000, whatever, right? Because the average return for Mag 7 was pretty high last year. I think it outperformed the market. Mag 7 outperformed the index. I mean, the broad market S&P was up 23.1% for the year. Pretty sure Mag 7 all by itself was higher than that. So anyway, rotation with those type of profits, portfolio rebalancing to say, I like Mag 7, but I'm going to go back to a 10% allocation. That rotation away from it's probably a good thing for diversification. I think that's a healthy thing this year. Broadening out into other sectors. Now, last year, every sector closed green, right? Every sector closed green. But there should still be a rotation or broadening out into other sectors. Financials is getting some big pumps this week. I want to say, I think I look at ETF inflows here. Let me take a quick peek here. ETF inflows. There we go. See what this shows. So ETF fund flows. Let's go till the 20th. Let's start out with this year. So go year to date. Okay, and we'll start with the SPY. So SPY year to date, submit. See what it shows. Okay. So for the last, I need to go. Let me see. I don't want daily. I want to go weekly. Give me weekly. Daily's fine, but I want to see weekly, right? If we go daily flows, I mean, the 17th on Friday, the outflows of the SPY were pretty aggressive, but we still gapped higher. So it's not like I can read this and be like, oh, I should be bearish today. I mean, is this a correlation where we have flows out on January 10th? What the stock do? So I'll come back to Amazon in a second. So SPY on January 10th, 7th, 8th, 9th. So the 10th, we did have a red candle on the day. On the day, we had a pretty aggressive sell-off in net outflows on the SPY. There was a big indecision candle for Friday. We had some inflows coming in. I mean, the big ones, if I went out, this shows daily still. I'm going to go weekly. Let's go weekly in update range. All right, so this gives me, for the last 2 weeks, we've had outflows in the SPY. End of the year, we had inflows. Okay, so we're outflowing first part of the year, which I think is interesting. Let's see if we can go to some sector ETFs. So let me go SPY. Let's add in. Please don't make me sign up for this crap. I was hoping I'd get some more data here. Okay. All right, fund flows. See if I can build this out. It may or may not let me. I might have to subscribe to this, but I'm looking for year-to-date SPY, and hopefully we'll go week-to-week intervals, weekly intervals. Let's see if I can build this out a little bit. If it's a pain in the butt, I can do this on my own. SPY, and we can do QQQ. I'd like to see a comparison. Oh, I can't compare. I was going to go GLD, TLT, some of the individual sectors to see. Anyway, let's see what this looks like. Submit. This one might show at least the SPY and the Qs. There we go. So net, you're showing a slight uptick in QQQ flows from last week's trading. Down in S&P, net is down. Okay, so be it. I'd like to see more, but anyway, for whatever free version, I'm curious if I can, whatever I can extract from this, I will try. But hopefully it's not an arm and a leg to subscribe to it. Let's find out. I just subscribed to a couple of the services. $145 a year. That's not bad. Unlimited access to ETF tools. All right. That might be worth looking at. Okay. All right. I'll play around with it. I might subscribe to that and see if I can build it out and have some more other sources from it. So, all right, let's go back to Amazon. Let's talk through, rotation stuff. So here, how do we establish a strong bull market? Rotation and broadening. We basically have to have a healthier, broader bull market. It's that simple. If the market is led by 10 stocks, it's going to be difficult to justify all-time highs and continued gains. So it's either all the good stocks have catch up, so the stocks that are performing well have underperforming stocks that catch up, or the other scenario, which is not a good thing, is that the best stocks fall down. Right? It's like there's going to be interdependencies with like those that are doing well. If everything catches up, that's good. Those that are doing poorly are heavy enough and strong enough that now they pull the good stuff down. That happens too. That's what 2022 was. When the market started to deleverage, everything was down, right? The inflation play in early 2022 was easy for the first like 3 or 4 months. Like January to April was all about commodities, energy, inflation plays. I mean, it was everything from like wheat to copper to trying to think, steel, aluminum, like platinum. Gold is okay, but more of like gold's been performing way better. But anyway, point is, after that little like 3-month move, everything was down. Tech was deleveraged back in November 2021, carried over into early 2022 with the downturn. The Qs turned a lot faster than the S&P. The S&P peaked out in January 2022 and was down for 9 straight months until we bottomed in October. All right, what else? So we need to have a healthier, broader bull market. I think we have to have, with Trump, I think we need to have some type of renewed optimism, okay, which We're getting a little bit of that. That's why the market is, I think, lingering around these all-time highs. We haven't had a huge correction yet. The market last week did rip a decent amount. It was one of the better weeks we've had for a while. But renewed optimism is kind of happening. But I think we need to have the promise and reality. Okay, meaning a lot of campaign promises were made, a lot of tweets, a lot of headlines, a lot of media, a lot of everything was, we're going to do this, we're going to be the greatest at this. Everything with Trump is superlative and hyperbole. But the question is, can he actually get things done? I know right now with like basically it's a a red country. He does have the power to have Republicans push things forward. But it's where are we pushing things forward? If we have mass deportation, that's going to be inflationary because it's going to drive wages prices up. It's going to be a little bit more strain on the labor market. If we have tariffs, that's going to be inflationary. It's going to add more global economy friction. We can say all these great things about crypto. I don't know if what he just did over the weekend for the last 3 days, 4 days has been like a giant, pump to be like the top of the market where it's like funny money going in. Fart coin is like a $2 billion market cap right now. The Trump coin is, I don't even know what the market cap is. I just know that his net worth went from 5 billion to 28 billion over a weekend. That's insane. And there's no real value. It's like that to me smells a lot like 2021 with NFTs and everything getting dumped into, you can just make money in crypto. You can just do everything and throw money at it. It's going to go up. It's like, I'm very skeptical of that because you saw how it ends, right? NFTs don't even get talked about anymore. Crypto market cap. It's like, look, I'm all for crypto. I like crypto. Bitcoin and Ethereum are totally good plays. You want to throw Solana in there? Okay, fine. But I just think the rest of it is just like, it's so speculative. It is so high risk. I'm not putting my money in the markets to chase stuff like that. So anyway, what is being promised? What is the reality of things that can get done? Right. So that's a big, that's a big gap to fill. So the news and the expectations and the promises of what the market is looking to price in, hopefully there's a reality there. And for optimism, it's going to have to be like things he is saying that would be, showing higher prices and anticipated higher prices in a good way, like higher asset prices. We have to see like realities come together, right? I would say the big thing here. Let's see, anything else with Trump? I don't know. Don't be crazy. I mean, um, I'll just stop. I mean, there's a lot of stuff with Trump. I just think if you expect the guy just to be falling in line with the next 4 years and he's going to feel like a president, it's probably not going to happen. I mean, all eyes on him. What he does, what he says, what he thinks about, everything is going to be public and everything's going to be in our face. And I know that people either love it or hate it. But 2016 to 2020 was a lot of that, and it was all over the place. And we had a crazy volatile 2018, and we had a crazy volatile 2020, and life has not been the same since 2020. You know, so I'm not saying that life is better. I'm just saying that things are different, and it's going to be a lot of in-your-face politics. It's going to be a lot of in-your-face political drama. It's going to be probably brash and contentious, and there could be things not just happening domestically, but also internationally. So there's a lot of potential unknowns and uncertainty with like how he handles the office and how he handles communicating globally. And that sparks a lot of volatility or creates a lot of uncertainty. So we've got to be prepared for that. And I'm being very cautious because of that. Now, what about just typical earnings and the Fed, right? Or we'll put earnings and policy. Let's say from the fiscal policy, it's going to be hard to continue to push higher government spending like we have for the last 4, 6, 8, 10 years. The last 4 years, it's finally on everyone's radar how much money the government is spending. Fiscal policy from the macro perspective is why the market sustained the gains that it did. Okay. With a narrow market, with the Mag 7 pretty much only carrying the markets for the last couple of years, especially, then you got the semiconductor play, then you got some crypto optimism come back the last 12 months or so. The government has spent an irresponsible amount of money. We've taken in over 60% more tax revenue and we've spent 99% more over the last 10 years. It's crazy. Like, it's fiscal irresponsibility, but we keep spending. I don't know if it's going to change. I don't think it's going to be better. I don't think we're going to balance a budget. I don't think we're going to have trade surpluses. We're probably going to still operate at deficits. You just wonder, how bad does it get? Monetary policy. Okay, right now we are essentially looking at the markets with the Fed possibly cutting one time this year. Now, I keep reading maybe 2 cuts this year, maybe 3 cuts this year. I'm like, I don't know where people are getting this information, because I'm watching the Fed tool, which is the most transparent tool that will change, but I don't see anything on the probability map for 2025 that shows a 2 or 3 rate cuts this year. I see 1, and it looks like it's June of 2025 would be our first cut by 25 basis points. So earnings and policy, earnings, I'll put this, priced for perfection or room to grow. Earnings need to deliver, I'd say, in a big way. And that needs to come like across the board. Now, there could be underperforming stocks that perform better, and that would be like the underperformers start to rally up and start to perform better. That's good. Price to perfection, like Mag 7 is going to be hard to go. I mean, I don't think NVIDIA is going 100% this year. I can see NVIDIA, if it's going to be anything, it's like if you buy it cheap enough and it gets up to all-time highs, that'd be a good trade on NVIDIA. Maybe 15% upside, maybe 10 to 20% upside, but I don't see NVIDIA moving 100% this year. I don't see Bitcoin moving 100% this year. I'd say that if the market's going to justify going higher, things have to be pretty good, because the earnings and the valuations, the price to earnings that we're at right now, the price to peak sales, all these things are getting to levels that we haven't seen in a long time. And our economy is not getting broader. Our economy is service-based. Our economy is now tech, and it's large tech. And what does large tech want to do? Innovate and cut jobs. Why? Because if they want bottom line dollars, they want to put more money into research and development. They want to increase their automations. They want to increase their efficiencies. People are not going to be benefiting from that. One person with the power of everything AI, everything, assisted Chat GPT to Grok to Copilot to whatever else is out there, people can be more productive, right? Coders, developers, gig economy, people can be more productive. That's a skill set, I think, that if you want to advance, you're going to have it. Not everybody's going to have that. So also, when you do have that, it does make the one individual worker more productive. But I wonder if one person can now do the job of 2, 3, 4, 5 people in a typical corporation, and therefore job numbers start to go higher, right? Your job losses rather. So if earnings is price perfection, we need room to grow. We have to deliver from Mag 7, I think, all the way down. This has to be broad base, not just at the top. We can't just perform well at the top. It's enough to carry the market in the near term, but I don't think we can sustain higher highs with 10 stocks doing well and 490 doing bad. Okay. Jobs. Are we doing more with less? We can watch wages and we can watch unemployment rate. Okay. So we've had, 44 consecutive months of job growth for non-farm payroll. The numbers are all over the place. It's mostly leisure, hospitality, services, okay, and government. We're not manufacturing much anymore. We have a net loss in manufacturing jobs. I don't know. We're not. It's like people are going to those sectors. It's healthcare, it's services, it's government. Those are the big providers of jobs. Last year there's the big debate on, we had the Sawm rule activate. According to the 3-month trend is all of a sudden trending the wrong direction over the 12-month average, and that's like this nuanced Sawm rule that still saw the markets make all-time highs. But for a second there, it acted like the market was going to break on higher unemployment, right, and job losses. But if we start to see an uptick in unemployment rate, it's probably not a good thing. Now, we're at historically low levels, but if we go from like a 4.1 unemployment rate to a 4.5 or close to 5%, it's probably not going to be a great thing either. The Fed has this mandate. They want jobs, they want monetary policy, they want market stability, and they want lower inflation. Okay, that's the other thing here. Earnings and policy. I would also say inflation is a big one. And we'll put here like, how sticky is it? How sticky is inflation? It's been trending up for 4 prints. Okay. Since September, October, November, December, now January, we have 4 prints showing that inflation on the CPI and PPI, core and regular, as well as PCE, things are getting, I'm not going to say like unsustainably higher, but they are sticky. Okay. And that is also why the Fed pivoted hard back in December to basically say, look, we're not in a place to continue to cut, you know? And I don't think if they cut because they have to, like, oh my gosh, the markets are falling apart, the Fed's going to cut rates. I don't know if that's going to help either, you know? So I think holding where they are, being restrictive, if anything, the stock market does not represent the real economy. Main Street and Wall Street are 2 different things. Okay. So can we have a recession while Wall Street's sitting at higher highs? Sure. Can we have a recession where Wall Street is going to go down? Yes. And because we've been pumped up so much the last couple of years since the bottom in 2022 in October, there's a long ways to fall to revert, you know? So we've been trending up in inflation. The Fed is essentially, without explicitly saying it, they're accepting a higher inflation reading across the board. Okay. But we can't inflate our way through a deficit. We can't inflate our way out of debt. We can't inflate our way out of a growth. You know, all we can do is inflate to just try to stay where we are, or somehow battle inflation by having other things that are going to inflate with it. So if we are invested and our assets are inflating because we, own shares or own stock or have some vested interest in things, I mean, we can gain, but we might just be offsetting the gain because things are still expensive and inflation still stays sticky, right? So anyway, inflation's not good, and that puts us into the 10-year yield. U.S. 10-year, which I've been talking about for months now, it's one of the most important charts to watch, and the relationship with the dollar index. The dollar went straight up from September's lows into the last month's highs, and the U.S. 10-year did the exact same thing. So from September 2024 to now, look at the comparison between the dollar index and the US 10-year. They're doing the exact same thing. So if the dollar gets weaker, US 10-year can follow. That can offer a little bit of relief in the borrowing window. And I mean, maybe give the market time to catch its breath versus just running hot, and all of a sudden it's now a crisis. I don't know. But I think the US 10-year over 10% or over 5% is a problem. Significantly over 5% is a break. Like, something will break if we get that 10-year yield over 5% and it's running hot and it capitulates higher. That could be really concerning. Okay. What else? So renewed optimism, promise, and reality. This all has to come together. I'm not saying the market is crashing. Like, this is not to paint a bearish picture. What I'm saying is I am cautious. Okay. I am playing income-driven strategies with plan A and a backup plan for, profit traps where I can roll, I can lower costs, I can have downside protection, I can have diversification, right? And also, I mean, obviously gains. I mean, I'm always looking for gains, but I'm just not doing crazy amounts of speculation. I think that is my least favorite play in 2025. Is I'm just going to go all in, or I'm going to be long this. It's like, I'm not long this, I'm not short this, I am just trading. And the nice thing about trading options especially is you can just trade for anything. I can trade for the market to, go down, and I can see the market going down and I can position for that. I can see the market going sideways, I can position for that. I can see the market going up, I can position for that. Now, what I don't typically do is I don't take a lot of trades where I'm calling the tops. If this market is going to go higher, I don't necessarily call the tops. I will position for markets to, if they do sell off, I position myself for some lows and retracements and corrections to happen. But I tend to get those trades where I can still scoop up some stocks or scoop up some indexes at really nice discounts. So I like those, 5 to 10% discount levels, and I can still make money, probably 80 to 90% probability, which is very high, and I can also build in some profit traps to go with that. Okay. So I'm cautious. Doesn't mean that I'm bearish. I think that right now it's like, if the market's sideways like this, it's actually The difference is I trade it and I'm okay. I'm actually sitting at fresh highs for the year and we're still well below the all-time highs, right? So it's not a bad place to start. I mean, I've seen P&L come in quite a bit this last week or two, and considering that's we started trading with the holidays disrupting. I mean, we really started trading this year like the 6th. So in 2 weeks of trading, I'm off to a pretty good start. I mean, if and this is totally hypothetical, but if I did, let's say we got 52 weeks, so let's say with 2 weeks of trading, that's 26 times 80. Okay, okay, would that be right? Nope, I think I make more. If it was 52, 2 weeks out, 26 times, so I got $80,000 times 26. Okay, so if I'm in the same, and this is again, like I said, totally hypothetical, but if I had the same pace of my profits that I've seen the last couple of weeks, and I do this for 2 weeks and 2 weeks and 2 weeks and 2 weeks, then that's what I'm going to make for the year. Do I expect to make that? I mean, that'd be amazing, but we'll see. So if all goes well for the next 2 weeks and the next 2 weeks, and I just keep doing what I'm doing and everything is paying out with like the same thing, I'm cautious, I'm playing income driven strategies, I'm trading all over the place from indexes to stocks to all these different asset classes, lots of options, I could still have a very profitable year. Okay. Which is what I'm working my butt off to do every year. But I want to make sure that I do it responsibly and I don't want to do it getting caught on the wrong side of something. And that's the most important thing for me. So type in a where yes if this makes sense. Okay, Ted, I see your comment there. New waterfall trades will be interesting. Yeah, I'm. And again, it's not going to be a full time thing, right? But it's like I think for right now, to me, it's a strategy that I can pull out of the quiver and we can deploy it. It makes sense. It's a high probability profit, and we can still define a risk. There's a little bit of a profit trap, which I always like, especially if I'm cautious with some type of downward move. But I like the trade. Okay, so we can start like stacking some of those up. Just depends on how much buying power we're going to tie up. So that's why I want to have defined risk. But I'm comfortable with all that. So yeah, between daily profit play and waterfall, and also with the double up alerts. I mean, double up alerts has hit my liquidity level I've been tracking for the last 2 weeks now. Since I said give me a break during the holidays, I was looking at low volume, and everyone in my double up alert service now. KMI hit my profit, Nvidia hit my profit, Amazon hit my profit, BAC hit my profit. I'm looking at the SPY or the Qs. We got earnings trades coming these next several weeks. So I mean, the nice thing is it's trading time, right? So there's going to be movement, there's going to be volatility, there's going to be catalysts, and all these things are good. I'm just trying to figure out, is it up or is it down? Is it something I need to trade sideways? Do I need to be cautious, remain cautious? Can I speculate with a higher reward to risk opportunity? So it's just be nimble, you know? I think if you always do what 2023 was or always do what 2024 was, my biggest concern for traders out there is they're so used to buying the dip. They're so used to the bull market. They're so used to everything as an uptrend. And I see it with the leverage instruments and the leverage ETFs and how much optimism and sentiment just gets dumped into things. And I see it with stupid things like a Trump coin, like fart coin, like NFTs. It's like I see funny money where it's like it makes you feel like an idiot when you're like, how did I not know about Trump coin? It was announced on Coinbase a couple weeks ago, or it was talked about as like a rumor. Nobody knew it was going to happen, and I mean, I have no idea who benefited from it. Okay. But that is not something I see now. And as a reaction, the play is I'm going to get into this now. I think that it's pure money at risk. And if it does something for you, excellent. If it doesn't, I'm not a chaser. So I see things like that. And it's like, I've seen enough of this. 2021. I saw this back in 2017 into 18. I saw this back during Brexit and currency markets. I saw this back with the oil crisis in 2014. I saw this during the great financial crisis in 2008 when everything was down for 10 straight months and it took 4, 5, 6 years to rebuild back to all-time highs. And I saw this briefly when I first started trading, literally during the dot-com bubble. you know, but I didn't know what I was doing in 2000. I was just a passive investor with some index stuff and some stocks that I liked. I wasn't chasing .com when I was 18 years old. I just put some money to work in the indexes because I had a retirement plan, you know. But I have seen enough to trade some pretty interesting markets, and they're more sophisticated, they're more evolved. It's faster moving. The rotations are more regressive and wild, or aggressive and wild, and you either evolve with the markets or you don't. So I try to stay nimble, and I try to stay um, alert enough where it's like it doesn't matter what happens here, for better or for worse. I'm going to try to make some money. And the nice thing is I feel like I've got a deep enough skill set and toolkit to do that. But these are the big themes I'm watching this year. The 10-year yield, I would add in there to the bond market. If we have a failed auction, or if we start to see that there's migration away from equities into bonds because it's just too risky to own stocks at these all-time highs, that's a whole theme too. The 60-40 portfolio, the boomers that would be retiring. If you're in your 60s or 70s, or you're looking for low risk, you're not in the equities right now. When you can get a certificate of deposit at 4 to 5% right now, it's essentially risk free. Yeah, your capital's tied up for 6 months, or it's tied up for 12 months, or a lot of people are trading like 2-year treasuries right now. I mean, in a let's say a 1 to 2 year window, you have a fairly risk free 5% gain on your money. A lot of people are willing to take that because we do have a very wealthy generation that is retiring right now. And they talk about like the transfer of wealth, and there's trillions and trillions of dollars from baby boomers into their kids, for legacy, inheritance and legacy. But if that money is safest with low risk, you're going to see a lot of money vacating the equities markets, and you're going to see it going into something safe. And I wouldn't be surprised if a 4-year drawdown essentially in the bond market is going to be different. When we're sitting here at higher rates, we're likely going to see gains coming out of the bond market. It's just a matter of does the correlation from bonds to equities break? We're trading at the highest correlation in the last 40 years. Right? Bonds to stocks are correlating like 0.73%, or I'm sorry, 0.73, which is essentially 73% of what the equities market's doing, the bonds are doing. That's really, really high. And if that breaks, you're going to see the bond market probably get a lot more attractive. With any type of fall in the equities market, you're going to see the bond market get a lot more attractive. So, but I want to say that the yields are going to have to change as well. We can't see higher yields and have the bond market get better. It's going to have to be, yields are going to have to get cut off at some point. And my concern is I don't see that happening. I don't know. I hope something doesn't break, but it's like every couple of years, something stupid happens. Even 2024, right? Even 2024, what did the market do? We had a pretty simple bull market in 2024, okay? But we did it also with 2 of the largest single-day volatility moves that it has ever had in 40 years. So it wasn't without risk, and it wasn't without some nuance, and it wasn't without some silliness. The market did some stupid stuff on August 5th and December 18th, but you're either exposed to it or you're not. Or you have cash and agility at the ready, so when something like that does happen, you can take advantage of it. Big move in implied volatility, big move in the VIX. And what do? It's a mean reverting instrument. It's one of the most reliable mean reverting instruments that we ever have. And so if you're selling that volatility instead of going long the volatility, which is also pays really well, but you had 2 big moves in an entire year. It's hard to time that. But if you're seeing the big move and you sell that volatility, it's also a pretty nice strategy to have as well. Okay. All right. Let's see here. Welch says, I see 2 cuts, July, November, slow roll to fix the current. Yeah, but right now the probability is still not favoring cuts, right? I see a cut in June. That's priced out in the probabilities tab for this FedWatch tool. Okay. So this is also extremely high coming into the end of the month on the 29th, which will be next Wednesday. The Fed is likely going to say nothing, do nothing, 99.5% of a pause. Now going into probabilities, I don't see anything that shows that we are going to cut more than once this year. Okay. Now I do see that, yes, a September or October, right, has a probability potentially of another cut. So you can see that we're here right now, right? We're at 4.25 to 4.5%. Nothing. Then the probability in the table shifts into 4%, which is going to be a 25 basis points cut coming in June. That is the highest probability for one cut this year. Now, pause has the highest probability. Pause has the highest probability, but there's a little bit of competition here for another cut. So September, maybe for another cut, but it's not probable right now compared to the pause. 36.5 in October versus 30.1. I mean, yes, September, October, and December, these are the next Fed rates for 2025. Potentially in this window, there may be room for another cut. But that's a big maybe, and that's a question mark. I don't know. But I don't think the Fed can keep cutting if inflation trends higher. Okay, if job numbers are trending the wrong direction, if we're trending higher in unemployment, we're trending higher inflation. If the 10-year yield will not stop going up, I don't know how the Fed can keep cutting. Right now, I do think that Trump's aggressive plan, as far as any type of market manipulation, would be if this is the last term that he can have and serve, and he wants to go down as like the greatest president ever. So on paper, he could do all sorts of stuff to get things passed, to beef up these markets and have these huge, maybe unsustainable flows. But if he does it for the next, let's say 3 out of the next 4 years, or four, I mean, for some reason, if he goes 4 for 4 with the stock market is higher every year that he's in office for the next 4 years, he might go down as financially and economically one of the greatest presidents. But what happens after, because there could be a lot of consequence for funny money, manipulation. Let's drive the dollar down. Let's cut taxes. Let's gut the government. Let's gut the Fed. Whatever. All these things that just, who knows, right? But on paper, he could go down as like he changed so much. But it's like, did he change Main Street or did he change Wall Street? Right? Wall Street is the greediest of greedy. Main Street is what people have been feeling for the last 4 years, and it feels like crap. Where nothing's getting better, things are more expensive, life is more expensive. How do you get ahead? Everyone's like the disparity gaps, the income gaps, the wealth gaps are just getting wider and wider and wider. Okay. Now, does everyone have the opportunity to climb the socioeconomic ladder? Probably better in the U.S. than most countries. But the gaps now, like what's considered middle class, what's considered, upper middle class, what's like those levels are almost like out of reach, I mean, the difference is like my next income bracket, it's like, I don't even know what it would be. I mean, I guess for me, it's like if I was making $1 million a year, that would feel like a big jump socioeconomically, you know? But until then, it's like I'm just going to keep operating in the same window. It's like there's probably a $100,000 to $200,000 area that I've been in for the last decade that I'm okay with. I obviously want to make more. I'm trying to make more. I'd like to gain more. I'd like to grind. I'll try. But that big jump it's a lot. But what I do know what to do well is like I can preserve my capital, take care of my capital, have an active hand in my finances, and I tend not to lose a lot when it comes to some struggles and difficulties in the market. So, 2022 turning that into a good year. 2020, having the courage to see it was a 10-year discount, so I bought everything during COVID. 2018 survived the vol event. From currencies to equities and options, it's just being an active trader. That's all it really is. But I do think that the wealth gaps have grown, and everybody knows it. If you're ignoring that for the last 20 years, you're silly. It's like people that have money make a lot more of it, and they're making a lot more of it every time there's a crisis. They make more money. Anyway, it doesn't matter. I'm not here to talk, socioeconomics or where people are at. I mean, do I think the U.S. gives everyone a pretty fair shot? No. I think we say we do. I think we pretend like we do. But there's all sorts of systemic things built into it. You know, I think when you take a college kid that's going to pull in $40,000 to $50,000 in debt, and you send them out into the real world to work and try to pay that off, and it's going to be like shackles around them for the next 5 or 10 years or more, that's a hard place to start anybody. So if we could get things like that under control, where people don't start their careers in their adult life with debt, I think we could have a better consumer. We could have a healthier economy. We could have healthier Main Street. But that's not where a lot of people are. So it's like, and that comes down to spending habits and other things. But it's like it's always easy to point the finger. But I'm just thinking there's a lot of stuff that could be better in the U.S. I don't like pretending that we're number one in everything when we're really not. We don't make anything. We don't produce anything. I think we've got one of the greatest markets in the world. We're 63% of the global market cap right now, which is insane. We're outperforming the world by like 3 standard deviations. That's insane. Everybody has flown into the U.S. That's insane. It's not a bad thing, right? So what does it take to dethrone the US? A lot. And so, like I said before, the markets have interdependencies. Either the US is okay, so I'll just put this here. So is this where we are? Is the USA up here, right? As far as performance, and then this is everybody else, right? Is this everybody else? Maybe. Okay. I don't think that that's necessarily the case, but according to our markets, if everybody else is below us, there's one of two ways this works. Either the US goes higher and drags others with it, the US goes sideways and allows everyone else to play catch up, or the US comes down to everyone else's level. There are interdependencies that are inescapable. We cannot be this immune, we're calling it American exceptionalism right now. We cannot be this island moat. Nobody is at risk in the US and everything is going to be perfect and we are so much better off than everyone else. I don't think that's true. If we want global economy to be frictionless, then we want things to be, bigger, faster, stronger, more efficient. And that ease of capital and that ease of flow and that lack of friction is, we can't have adversaries. We can't have trade wars. We can't have conflict and wars. So either we provide a global economy that has everyone else that can catch up with us and get up to where we've been the last few years, or everyone else is so worse off or not getting better that we don't get the benefits because it is now so obvious that we're operating this much better, but we can't sustain it. So we either can go higher where everyone else can join us. We can go sideways where those can catch up, or we go down because we're basically playing down to where everyone else is at. Right. So it's not going to be easy, and it's not going to be if there was a crystal ball, we'd all want to have it, but there isn't. And I don't know what 2025 is going to look like. I've got typical seasonality. I expect the market to be positive. 56% of weekly candles are green, and 54% of daily candles are green. And the market likes to carve out gains and averages. And on average, the market is positive. 8% a year, 9% a year with dividends, 9 to 10% a year. Cool. That's your average. That's 80 years in the market. But we can also have, if the market's expected to turn 10% profit, that means we could have a 15 to 20+% drawdown at any time. And if that is risk that people are unwilling to take, then you're going to see less inflows in equities and more inflows into bonds, money market, certificates, deposits. You're going to see better for financials, which is probably why the financial sector is doing well this year, which is why it could continue to benefit from higher yields because people are playing that. If you, again, depends on your capital, depends on what you're trying to accomplish. But if your goal is, I don't want a lot of risk, well, there's ways to trade right now to not have a lot of risk. And it's not in equities. Your trade would be, I'm willing to go illiquid for 12 months, park something that makes me 5%, and it's essentially risk-free. I put essentially in there because we did have a bank crisis with 2023 in the Signature Valley, First Republic, or Silicon Valley for what was it? Signature Bank, Silicon Valley, and First Republic were the three big ones, and we had that little crisis. Anyway, we have huge banks that are monsters. I think if you're doing any type of money market, any type of yield play that's fixed income, I would stick to like the biggest banks. I would stick to the too big to fail. And I know maybe you don't like them, but I don't think a Bank of America is going out of business. I don't think a JP Morgan is going out of business. I don't think a Wells Fargo is going out of business. Those are massive institutions. But like a regional bank or a credit union, who knows? So point is, we'll see. But I just want us, I think we have to trade with eyes wide open and head on a swivel. I think that's going to be really important for 2025. Now, if it starts to look better, then fine. I will change this up. I will be a little bit more biased towards I think we have room to run. I think we have higher highs to go. I think we have some momentum now. But right now it's I think that the wheels are turning. The problem is we don't know when the gates open, whether we're going left or going right or going straight. So let's find out, and I'd rather not guess and anticipate right now when I don't know. So I'm being cautious and I'm playing the upside, I'm playing the downside, I'm playing sideways, I'm doing all sorts of random strategies. I've got a bunch of diversified strategies and assets running. I think I'm happy with that. Right. And I've got some bots running in the background that'll do their thing. So it's I'm okay. Now, could I, tilt my portfolio to make more money if I see, better plays ahead? Of course. When I find an opportunity to get more aggressive, I want to get more aggressive. But I don't think now is that time. Okay. Correct. All right. Fair share of inequality. Kids joining labor force at 50K. I know it's ridiculous. I mean, I was one of those kids. I mean, I've carried six figures of I carried six figures of student loans through undergrad and grad school. I had six figures. So and I still I struggle with the idea of why would I pay it all off? What the benefit of it to me is, okay, if I can budget, let's say $10,000 a year to pay for student loans, well, I can use the cash that I have available to trade and make, 50,000 a year, $100,000 a year. To me, that is my arbitrage, where I can justify keeping that debt to then keep the cash and the money that I have in order to monetize it or leverage it. But it sucks. I hate that I have loans. I hate it, but I'm also just not willing to part with the cash to basically have a reset, or have a cash amount that I'm like, oh man, I had X amount of cash and I just dumped, 50 grand into debt. I dumped 100 grand into debt. I'd rather put that into a house. I'd rather put that into an asset that's a little bit more preserving, as opposed to, well, I'm just dumping it into the student loans. But they add up, man. I mean, and I'm not, anybody that has them knows, anybody that's in college knows, it's not going to be easy. But I don't know. The era of cheap money has changed. I mean, I've seen interest rates on my student loans go from 3 to 4% up to 7, 8, 9% for variable rates. And have I refied it fixed? Nope, I haven't. So I've got some of my smaller loans that are up a little bit higher. I don't know, why necessarily and how they've jumped this much, but that doesn't help either. So all of it sucks, but to me, it's like I can justify keeping the debt and budget the student loan payments when I can make money elsewhere. And, I make a lot more money with the cash that I can invest with, as opposed to just paying it all off and have way less capital to work with. It'd be the same question as, hey, Chris, I've got $10,000 in an account. How can I make a lot of money? Or that same person that says, I want to make X amount of money per day, per month, per day, per week, per month. But if you came to me and said, I've got $100,000 to work with, is it reasonable for you to make $10,000 on this account? I would say, sure, that's highly reasonable. But if that same person says, I've got $10,000, I don't make $10,000 in the account, it's doable, but that's a lot more risk. You're essentially going to have to risk your entire account to make that type of return. So for me, it's like, once I got to a certain point for capital to trade, I wanted to make sure I preserve that and I can invest it and I can grow it. And if it pays for the loan, so be it. But that was my decision. But it still sucks, man. I hate it. I have, the services have changed over the years. I've got all these different names now that I pay loans to, and they're getting passed off and thrown over to somebody else. Whatever. You just follow the spider web. Okay. So anyway, all that stuff. All right, let's start wrapping things up for today. I think the wrap up is here. Plain income driven strategies, a lot of diversification. I'm not bearish. I am cautious. Okay, that's probably the best way to summarize it. I'm also tailoring my services to show this and express this and resemble this level of caution. Now, all my services have flexibility in them where we can trade for daily and weekly and monthly strategies and incomes. We can have the markets where, whether it's up, down, or sideways, you can still make money. That's good. And there's a couple ways. It's like, look, it's my service. If I want to modify the strategy, I'll modify the strategy to make it more successful and profitable. I'll do it. Right. So that's what we talked about today. So if you're in my daily income, if you're in my waterfall income, if you're in my double up alerts, I mean, double up alerts is good. We're just back to normal now. We've got the markets ready to rip. We got earnings season that's upon us now. We got a couple of plays we can look at, for this week. That was just nice. I want that. I want that volatility. But for the daily profit play waterfall, I trade a lot of indexes with those services, and I want to make sure that we can use option strategies to our advantage to make sure it doesn't matter what the market gives us. We can look. We can even benefit from outliers. We can even benefit from outliers. But I would like to see, just like whatever the market does, we'll figure it out. So don't trade like an idiot. Don't risk everything. Put this out there. What do you expect to do this year? If my goal is like, okay, I'd be happy making, 20% this year. Cool. Well, that 20% is probably going to come with a 20 to 30% risk. That's about right. And that's a lot, right? So this is why I trade a lot of options. This is why I diversify a lot, because for me, my 20% risk was hopefully going to come to like maybe a 5% risk, maybe a 10% risk. I'm trying to keep my risk adjusted return as high as possible. And that is challenging every single year, because you never know when you're going to have a black swan event. You never know when you're going to have some type of outlier. You never knew on August 5th you're going to have the largest volatility move the market's ever seen in 40 years. And also 4 months later, 5 months later, you're going to see the second largest single day move the market's ever seen in 40 years. Like that to me is the asterisk on 2024's performance, which was a pretty steady bull market that got really narrow and really concentrated and just showed how brittle and fragile it could be. It still was okay. It still ended up being resilient, but my gosh, August 5th could have been way worse. And December 18th and following to the year with thin markets could have been way worse, but it was okay. But it can get way worse. It can always get way worse. So make sure that your risk side is under control. Okay. Seems like too much work and complicated strategies trading options for a 20% return. What's the alternative then? Put it in a money market for 5%, walk away? Go ahead and do that. Okay, it's not working upkeep when you're making 20% with manageable drawdown. It's called trading. I mean, that's insane to think like everyone's just like, well, that's way too much work. Well, what's the alternative? Is there an easy way to get 20% a year? And the answer to that is, well, yeah, just trade in the Mag 7. Just invest in Bitcoin. Okay. And that comes with zero drawdowns, right? That comes with no risk. I mean, that's a lazy answer. There's always risk in these markets, and I can control that risk with options. And so yeah, I'd rather have, I don't know, I'd rather look at my trade right here on the SPY and say that I've got a lot of exposure on the Qs right now, diversified, but it's out there. I've got a lot of trades on the SPY right now, but it's diverse. I don't care. I can manage these trades. This is why I track my trades. This is why I have spreadsheets. It's worth the work to me, but that's my control, not yours. If you want the easy way, I don't know if there is one. The easy way of like, you can invest and be passive. You could dollar cost average, but you're going to deal with some drawdowns. If the market drops 20%, most people that are invested in the market watch that 20% go with it. The market goes down, they're down, right? Most time the market's down 20%, your stocks individually are down double that, triple that. It sucks. So there is no easy path to 20% a year. There is no easy percent to gains every single year. Otherwise, you just keep dollar cost averaging and don't look back. Have a 10-year horizon, don't worry about it. Have a 20-year horizon, don't worry about it. But if you want to make money this year, you want to make money this quarter, you want to make money this month, got to be active. So to me, it's never too much work. It's a lot of work, okay? But knowing that I can have a lot more control over my risk, I would take that all day over like, I'm just at the mercy of the market. I hope it goes up. It seems easy. I'll never believe that. Okay. My point is, why do you spread in strangles and condors when you can just trade the position with a 1% risk and that's it? Right. But that 1% position, let's say that you're buying the top. Okay. You put in a 1% stake and you're buying the top and the market drops 10%. Okay. Or the stock drops 20%. Then what happens to your 1%? You just buy back more. Then you put in a 2%, 3%, 4%, 5%. Now you're underwater. You're still trying to build back to get that position positive. I'm just saying I'm managing positions. So you trade whatever you want, man. But I don't mind having to find risk. So options help me a lot. It's helped me go from, taking on the crazy amounts of risk to tightening my risk up and having good upside where I can still perform at a high level and take on way less risk. So just that. But there's all sorts of ways to do it. I'm not saying my way is the only way. I'm willing to put in the work. I'm sure there are easier ways to do it. But I like the easier ways. I like the ways that I can also limit the risk and limit the drawdown. So that is a lot more work. It's a lot more work to control the risk and control the drawdowns while also still producing, high gains. That's tough. If the market cooperates and sentiment is strong, like, yeah, there's easy investing out there and it seems really easy. That's what bull market geniuses have. and they look good in 2020 and they look good in 2021 and then they lose everything in 2022. And then they look good in 2023 and they look okay in 2024. And then maybe in the next 1 or 2 years, they lose everything again. This market will continue to drive bulls and bears. Pigs get slaughtered, and there's going to be bubbles and there's going to be booms and busts. And that is the world we live in. So you can either choose to, understand it to try to protect it, to protect the downside and benefit from the gains or the income. And also, what if the market goes nowhere? That's one thing that nobody looks at is we've been so conditioned to think like this market has to go up. It's going to go up. It's got to go up. What if it doesn't? If this market goes nowhere, right? If this market goes nowhere this year and all we have is like a crazy stupid range. If we go back to the index right now and all we have in the index is something like this. Let's say the best thing this market could do is get up to this high and then get back down to this low and then get back to this high and back to this low. And this is like 2015-16 all over again. A 1% stake is going to yield you nothing. Okay. I could trade lots of trades down here. I could trade lots of trades up here. I could do all sorts of stuff. I can still find a way to carve out income. Is it work to do that? Yeah, it's work to do that, but it's worth it. Trade the market. Trade what you see. If this market's not going up, 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 that strategy doesn't make any money. If this market's not going down, 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 that strategy doesn't make any money. If you don't have a strategy for this or this or this or all the above, it's hard to make money. If it was so easy, everybody would do it. Every single year, everybody would do it. I don't think it's that easy, but I like the challenge, And if it was easy, I wish it was always easy, I wish it was always easy and it was just like set it and forget it. Everything's going to be great, but I know that's not the case. There's always going to be silly stuff that happens. So this is where we're at. This is the index. I could see us maybe having a little bit more upside here to revisit all-time highs, which would be a little bit exciting, but I don't think that's sustainable. Or this just on Friday was a bull trap, and this market's going to drop and fill some gas, and we're coming back here in the next couple of weeks, and we're talking about this right through the lens of falling back to find some balance. That was a close call back in August. We could have a nice orderly correction down to this area, establish a nice little base and foundation, and then justify why we can make higher highs. Maybe higher highs. But I don't think this is an environment to say like we've got a bull market, right? This is also not an environment where I say this is a bear market. This is an environment where I say it can go up, it can go down, it can go sideways. I need to be ready for anything. If it looks easier to trade, then I'll trade it. And we've already talked about this for the last several months. It's like if I get down to these areas, I'm pretty interested in establishing core long positions to go back and see if we get to all-time highs. Okay. Yeah. Well, that's you trading one asset, man, which is fine. If that's all you want to do is grind out, you can risk and get your fine, do it. But that it's totally different mentality. I'm not a day trader. I've given up the day trading stuff. Like as far as in scalping, it's like I did it for too long with FOREX. It drove me crazy. It's not my mental preference. Like I would rather be, I don't know. I like making monthly income and I get big swings where it's like, my best year last year, I can look at I think my best month last month or last year. Let me look at it. My best month in 2024, I had a 16.78% month last year. That didn't come from day trading. It's like that came from building positions and having things work out, and it was a nice little chunk. I had low gains. I had a month where I was down 2.5%. I had a month I was down 4%. Gains of 1, gains of 4 and change, gains of 3.6, gains of 5, gains of 5, 4.69, 8.2. But they come in all shapes and sizes. So yeah, we can agree to disagree. I'm just saying like nothing is easy. Because if it was like everybody would do it, it would be the easiest thing in the world, just be like, I'm a trader. But it's not. Because what happens most of the time is people get emotional with real money on the line and they mess it up. It's too easy to mess it up because there's no education that goes into trading. If you want to put money in the market and say, I'm a trader, you can be a trader. Congratulations. But if you want to make money as a trader, it might take a little bit of education. It might take a little bit of know-how. It might take some experience, which might make you it might take you 6 months to learn how to trade an asset or learn how to trade a strategy or learn how to trade an asset class. But most people don't do that. Most people don't have the time, the energy, the patience to learn. And what do? They just jump in, they risk, they lose, they leave. It's a revolving door, and I've seen this for a decade plus because I've been in education. I've taught traders, and I know that when traders gamble and trade irresponsibly, they typically don't stick around. But I think your first order of business is survive. You can survive by controlling risk. You can figure out and specialize what asset you want to trade, figure out your strategy that you really like, and then go with it, and then grind it and do the same thing. Be the Bruce Lee that, it's the 10,000 kicks. What is it? I fear not a man that does, 10,000 kicks. I fear the man that does one kick 10,000 times. You want to be good at something, do that. Know it so well, and maybe that's you. Know the futures market so well, right? So I would blank that and say, like, yeah, I know options pretty well. I trade a lot of options. That's my 10,000 kicks. All right. I'll let you go. Have a good day. I'll see you tomorrow. Bye.